We start on the developing events in the Middle East, where a ceasefire between Israel and Iran that went into effect this morning has now been breached, according to Israel. They have reported further missile fire from Iran, but Tehran denies this. Both sides had earlier confirmed that the US-backed truce had begun, a move that immediately sent the price of oil sharply down, dropping around 5% in early trading. It's since made back some ground. For more, joining me now is Dr. Jorge Leon, energy economist at Rystad Energy. Jorge, that 5% drop or thereabouts earlier, what gave the market so much confidence when that happened?
Good morning, Mark. Well, essentially this drop, it was a result of a lower geopolitical risk. The traders and energy market analysts believed that this was a closed chapter. Now, just as you mentioned just a few hours ago, there seems to be increasing tension again, and that was clearly reflected, immediately reflected in the oil price. It dropped to $67.5 per barrel, and now it's closing, edging higher, close to $70 per barrel because of this fragile ceasefire that we're seeing.
I guess a reminder of why the Iran and the Straits are so crucial for energy and oil. Sure.
Around 20% of the oil the world consumes passes through the Strait of Hormuz, and that shows how important this choke point is for the global economy and for the oil market. So any threats to close the Strait of Hormuz could have significant implications in terms of supply disruptions and therefore on oil prices.
And natural gas prices have dropped too, a sigh of relief for some in Europe, but not as low as May's figures.
Indeed, because we still have the tension, we still have this fragile ceasefire. But to give you a sense, around 4% of global oil or global gas demand passes through the Strait of Hormuz. So in terms of volume, it's less important for gas, it's much more important for oil. And that's why you see that the price reaction is much more amplified for oil as opposed to gas.
Well, on oil, if things do remain calm, and that is a big if at the moment, where do you see the price settling?
Well, we should see things, if things calm down, I think we should be seeing prices back to the pre-crisis level, which is around $65 per barrel. We're still above, we're closer to $70 per barrel because of this uncertainty. But if, and again, that's a big if, things calm down, then prices should gradually revert back to the 65 mark.
Okay, Jorge Leon from Rystad Energy, thanks very much for joining us on the program there. So, how are the global financial markets reacting to the latest developments? European stocks all opened up sharply this morning on the back of the main Asian markets all closing up as well. Let's get the latest from Jane Foley, head of FX strategy at Rabobank. Things are moving fast, Jane. What are the latest?
Well, of course, as you just said, there is a breath of relief across the markets today. But of course, we also know that ceasefire is very fragile. So laced in amongst that optimism is this sort of air of tension still being there. Now, of course, we do have the headlines this morning from Israel that there may have been a breach of Tehran, as you said, already denying that. But the market, generally speaking, is seeing this as perhaps a chapter which is coming to the close. Now, I would also say that even yesterday that the market was betting really that the worst case scenarios for this conflict probably wouldn't be rolled out. Oil, of course, could have been a lot higher than it was. The market appeared to be betting yesterday that Strait of Hormuz, that choke point that you've just been talking about, probably wouldn't be closed. But nevertheless, a big relief today with oil prices significantly lower, equities across the globe higher, and the dollar, which yesterday was behaving as a safe haven, generally softer.
And is that what you're seeing looking ahead to the US when it opens in a few hours' time?
Well, of course, what this means is that if the conflict perhaps is taking a lot less attention, the markets will get back to the day-to-day business of watching economic data and also commentary from central bankers. I mean, we've got a lot of that this week, not just from the Bank of England, but predominantly we've got Fed chair over in the US. He will be grilled today by members of the House of Representatives, and the market is looking for signs as to whether or not the Fed can actually cut interest rates in the coming months. Now, had oil prices remained high, well, that, of course, would have been very inflationary, not just for the US, but for various countries around the world. And that could have really complicated the outlook for central bank policy.
Jane, when you take one step back and you look at Donald Trump's policy changes, which I think the market's getting used to now, and Iran's subdued response, we saw that attack in Doha, but more orchestrated than instinctual. And then we have this deadline for EU tariffs, the 50% deadline on the 9th of July. Are you surprised how unfazed the markets are at the moment?
Well, the markets have, again, perhaps this could be jumping the gun, but the markets have come to the conclusion that perhaps some of these tariffs will be rolled back. But again, that optimism could be short-lived. We do have news that the Japanese trade negotiations could be in Washington again this week, I think for around about the 7th time. Now, if those go well, then there will be, again, more optimism regarding the outlook for Europe and the trade negotiations there. But if these tariffs sustain beyond the deadline, well, the markets will be concerned about US inflation, and that could certainly impact what the market is expecting for Federal Reserve interest rate cuts, and also, of course, for the pace of global growth.
Jane Foley from Rabobank, as always, great to have you on the show. Thank you. With the easing of tensions, we are getting reports that disruptions to flights in the region may also lessen. Airlines across the world have cancelled flights to the Middle East and rerouted other flights amid safety concerns. Qatar had temporarily closed its airspace. Virgin Australia's scheduled services to Doha, which are operated by Qatar Airways, are expected to operate today with delays following the reopening of the Qatarian airspace, and some airlines are continuing to halt flights to the Middle East. British Airways says it has suspended all flights to Doha up to and including June the 25th. And budget carrier Wizz Air is cancelling flights to and from the United Arab Emirates until the 30th of June. It's a region that has become more and more important to the airline industry, as analyst John Strickland explains.
That's right. We have 3 major hubs there. Many travellers from pretty well all continents of the world will transit through those hubs on their journeys, and particularly from east to west, but to a degree from north to south. Qatar had to cancel all flights, of course, while the airspace was closed. But the volume of traffic is so great in and out of those hubs within the region and overflying the region as well. We have services from Europe and US going through to Asia, Indian subcontinent in particular, and vice versa. But if that traffic has to be funneled into ever decreasing amounts of airspace, the minimum that happens is that flights are delayed because they're taking longer flight routings. That also means, of course, increased fuel burn, the airlines pushing up costs. And it can mean that the longer flight time can put crew hours into question, and crews may run out of legal flying time available within rest requirements, leading to cancellation. So it's a major headache for a large number of airlines.
Well, as John was saying, it's not just flights that are being affected. The conflict has also been pushing up insurance costs for ships travelling through the Strait of Hormuz. Data from the world's largest broker, Marsh McLennan, showed prices leapt 60% last week. Well, for more, joining me now is Marcus Baker, Global Head of Marine and Cargo at Marsh McLennan. Great to have you on the show, Marcus. 60% jump last week. Where are we at now?
Yeah, it's a great question. Right now, I think it's a tough call. But if I could just take you back a little bit, you talked about a 60% uplift. Certainly, back end of last week, we were seeing rates for transits through the Arabian Sea of about 0.15% on the valuation of that ship. So it's 0.15 multiplied by the whole value. As of yesterday, clearly after the activities at the weekend, I suppose reflective of the sentiment in the insurance market, we were seeing rates of between 0.25 and 0.45%. So a significant uplift from where we were last week, which was on the back of some uplifts prior to that. So, we are still seeing an element of nervousness. And I think once we see whether this ceasefire actually holds, that will allow us to have a better perspective on the appropriate rating environment.
Now, Marcus, if my maths is correct, we're talking about, for a $10 million load travelling through the Straits, around $200,000 in insurance. Is that per trip?
$100 million ship, yes, that would be the appropriate number. That is per voyage. That's additional premium.
Right, sorry. So for a 100 million voyage, you've got 200,000 per trip that you have to pay. When does it become too expensive to insure the vessel? What's their breaking point?
Yeah, again, I think, one has to look at some of the past conflicts that we've seen around the world. When Russia invaded Ukraine, the rates went up to about 5%. Now, to put that into context, Russia were at that time attacking shipping and announced that they were. So there was a perceived exposure there, heightened, unlike now when we don't quite know what's going to happen next. So there is clearly a concern around that. Look, I mean, the implications on the cost of a barrel of oil, this part of it, this additional premium, I would suggest is only a few cents per barrel. We'd clearly like to work that out, and I can work that out. But I think at that stage, that's probably where we sit. And
when you've paid for your insurance, what's covered? Is it the ship, the cargo, the crew, and who's paying for it?
Yeah, so look, fundamentally, the ship owner will take care of things like damage to the ship itself, and the crew injuries, the pollution, those types of things are all taken care of by the ship owner. The charterer will have an obligation to ensure certain things, which is the contract that he has with the ship owner, the charter party. And between them, they will decide who pays for this additional premium to go into areas that are considered of heightened risk around the world in terms of additional premiums for war coverage. Can you cut your insurance cost if you have your own security on board? Yeah, I mean, clearly there is, especially for piracy, when ship owners are protecting their crew and protecting their assets by ensuring that actually they've got appropriate security guards in place, that is going to have a positive impact upon the cost of premium. But let's look at this. There's not an awful lot that a security guard can do against a missile coming at him. OK. Marcus Baker from Marsh McLennan, thanks very much.